I'm told that this is something like year 14 or 15 or something like this, 16, that I've done this with you. Thank you very much. It just means no one will come here so late at night. I'm so privileged to be here in Hagerstown, in Washington County, to speak with you. It's really interesting times. I think this year we've got a lot of material to cover. Very interesting elections last night, and so let's get right into the material. As I have done in years past, I'll start out very broadly, first with a brief primer on the global economy. I'll then quickly taper down into national level economic data, and then share with you data specific to regions around the country, but of course a deeper dive into Maryland and Washington County dynamics. I think you'll be very pleased with the Washington County data this time. It's the best performing economy in years around here, and we'll talk about why that is. We'll talk about energy markets, financial markets, labor markets, real estate and construction markets, all manner of markets, before including with a forecast for 2019 and beyond. I've entitled this year's presentation, Brown Sugar, Deriving Satisfaction Through Data Analysis. It's a bit cryptic, but the theme this year is the Rolling Stones. And you'll see that theming throughout the evening. I did want to offer, though, this year, and this is the first time this has happened in the 16 years, disclaimer. I think it's important to protect myself from any and all legal liability, and so this year I'm just doing that a little bit extra just to protect myself. And so the disclaimer is simply this: any resemblance between the presentation's title and the speaker is purely coincidental. So let me get into that global data. So a lot of negativity this year. A lot of the focus this year has been on tariffs and trade wars. And yet, believe it or not, people around the world are shockingly confident about the near-term economic outlook. I mean, given all that negativity. Hopefully this will work, we have a growing global economy. It's been growing for quite some time. This is no longer 2008, 2009. We're not in the midst of a global financial crisis. Yes, true. There have been some emerging issues in the emerging world. We'll talk about that in a moment, faltering currencies, that kind of thing. But the world is growing economically. And we can see evidence of this confidence through many different lenses. Here I'm showing you I will ultimately show you, I'm pointing it right at you. There's a gentleman. There you go. Here I'm showing you the Ipsos Global Confidence Index. Ipsos is a private consultancy in Paris, France. Lots of dots on the map. Perhaps you can see some of them. Red dots signify pessimistic societies. People who believe that the near-term performance of the domestic economies will not be good. Back in 08, 09, all the dots were red. Shared global financial crisis. If you look now, you see very few red dots on the map. They've largely evaporated over time. You see one attached to Turkey, one attached to Argentina, but there are these emerging world issues out there, but for the most part, they're gone. Supplanted in many instances by yellow dots. Yellow dots signify moderate levels of confidence. You'll see those in South America, Europe, Asia. But now we even have some green dots on the map. Green dots signify optimistic societies. And there's a self-fulfilling prophetic aspect to optimism. If people are optimistic, I think you'd agree, if they're heads of households, more likely to spend on retailed items, more likely to buy a car, more likely to take a vacation, more likely to buy real estate. If they run business operations, they're more likely to invest in equipment, hire, open up a new office. And it's those infusions of money that generate those superior economic outcomes. And you'll notice green dots attached to some of the world's most important economies. America, largest economy in the world. Canada, 10th. Mexico, 16th. China, 2nd. India, 7th. These are some of the economies that can really drive the global economy forward. And again, surprisingly, there's a fair amount of confidence. Now, this is a rather static way of looking at confidence. One can embrace a more dynamic approach. This is the Organization for Economic Cooperation and Development's Business Confidence Index. A lot of spaghetti on the slide, but what it's trying to show you is that people in the advanced world are more confident than they were a couple of years ago, let's say 2015 or 2016. So the red line signifies or designates the OECD, the Organization for Economic Cooperation and Development, basically shorthand for the advanced economies of the world. France is a member, America is a member, Japan is a member, advanced societies. People in the OECD, those 30 plus nations, collectively are more confident than they were a couple of years ago. That's what that says. Despite the fact that over the last 2 years we've been talking about tariffs and trade wars and Brexit. The yellow line represents the 19 nations that use the euro as their primary currency. Now, true enough, if you look at these lines, people haven't necessarily become more confident over the past year. Well, yeah, that's true, because we've been talking about tariffs and trade wars and Brexit and so on and so forth. But they're far more confident than they were back in 2015 or 2016. And then the blue line is America. And though we can debate the merits of policies related to tariffs or to shifting immigration policy in America or Europe, or other policies, there are certain policies that continue to be quite supportive to global economic growth, including global monetary policy. Here, the nations in blue are attached to a central bank that's still easing monetary policy, still creating more money supply, still keeping interest rates artificially low. The global financial system is flush with cash. That's what I'm trying to say. Now, North America is not in blue. The Mexicans have been dealing with a bit of an inflation issue, so the Bank of Mexico has been tightening monetary policy, increasing interest rates, for instance. The Canadians, broadly speaking, have been recovering in conjunction with us, so the Bank of Canada has been tightening monetary policy, and of course our own Federal Reserve Bank raised rates in September, signaled that they'll do it again in December, at least 2 times next year, have done it 8 times in the last 3 years. Interest rates are higher. Balance sheet is shrinking. But here's the point, from a global perspective, there's nothing that stops a newly created euro or a newly created yen from ending up in our stock market, our bond market, our commercial real estate market. I don't know if you saw what the stock market did today. Phenomenal. Dow Jones back above 26,000. And I know the midterms had something to do with that, but one of the reasons that we have seen this dynamic of whenever the market falls, as it did for much of October, it bounces back is because, my goodness, there's so much money in the world, and it has to go someplace. And ultimately, when investors look up, they say, my goodness, is there a better place to invest in than America? And the answer is often no. So global capital continues to flow here, and we can see, of course, very lofty asset valuations here. We'll talk more about this as we go through the presentation. So because the world is flush with cash and has a fair amount of confidence, no surprise, the outlook is pretty decent. This is the International Monetary Fund's forecast for global economic growth in 2018, current year. So last year, the global economy grew 3.7%. This year's forecast, 3.7%. This is from the October updated forecast report. The 0% expected growth line runs north and south through that slide. You don't see anyone on the wrong side of that line. True. I left Syria off the chart. Venezuela also did not make it this year. So I can find few societies that are backsliding, but when economists or others indicate that it's a synchronized global economic expansion, all they mean is that each of the world's major economies, whether developed or developing, are expanding economically, and we've lacked that simultaneity for roughly a decade. So whether it's the forecast for the Canadians of 3.2%, and again, this is just for the International Monetary Fund. You can find different forecasts from different sources. Or whether it's the American forecast of 2.9% growth, or the Chinese forecast of 6.6%, India 7.3%, even Russia and Brazil are expected to grow economically this year. Both of those economies, significant economies, were in recession back in 2016. Particularly remarkable for the Brazilians to have been in recession, as that was the year they hosted the 2016 Summer Olympics and then had to rebuild much of their society after the departure of American swimmer Ryan Lochte. And so you look at this, you say, this is a pretty good setup for America. It's a supportive global economic environment. World economy is growing. All things being equal, it's good news. Now, all things are not equal, because one of the other aspects of economic life is a very strong US dollar. So today, if you look at it, 1 euro can buy around $1.14 US. For much of its history, 1 euro could easily buy well over $1.20 US. Euro is weaker, dollar is stronger, which means it's harder for us to sell our goods to Europe, and it's easier for us to purchase European items, all things being equal. No surprise the trade deficit is rising. Today, $1 can buy 114 Japanese yen. Take a look back 2 or 3 years. $1 can only buy 100 Japanese yen. Yen is weaker, dollar is stronger, same dynamic. The Canadian dollar today can buy about 76 cents. Take a look back a few years. One Canadian dollar could actually buy more than 100 cents, 105 cents at one point. Nominally, there was a time when the Canadian dollar was actually stronger than the US dollar. And so the trade deficit is growing. But the fact that the world economy is growing, that in and of itself is not bad news for the Americans. And we'll talk more about this later on in the presentation. Okay, enough of that. Let's get into the US-oriented data. Let's talk about the American business cycle. Now, you've probably heard this a million times. This is now the second longest recovery in American history. We are now in year 10 of this economic expansion. And one might have thought that after so many years of economic growth, so many years of working so hard to escape the clutches of the global financial crisis, the Great Recession, that by now there'd be a weariness to the economic expansion. It'd be getting tired of old age. But along many dimensions, it's as if the recovery is just starting up again. That there's a level of dynamism presently in the US economy that we've heretofore not enjoyed over the past 8 or 9 years of expansion. And again, confidence plays a major role. You've probably heard this a million times. The consumer is 2/3 of the economy. All that means, of course, is that consumer spending represents 2/3 of aggregate demand. But since 2010, which was the first full year of economic expansion during this cycle, consumer spending growth has represented 3/4 of all economic growth in America. It has been the consumer who's done the heavy lifting, which means, of course, that the other components of gross domestic product, business investment, government spending, exports or net exports, have collectively represented a mere 1/4 of economic growth. It has been the consumer at the vanguard, and the consumer is still there. More people are working. We'll talk about the labor market data in a moment, but the consumer is confident. My goodness. They feel good about this economy, and they feel good about economic prospects. People are sometimes surprised when I point out just how confident the consumer is. Because if one watches CNN or MSNBC, one believes the world is ending on a nightly basis. If one watches Fox News, of course, one believes the world has been rescued from its end. But the Consumer Confidence Survey does not ask questions like, hey, what do you think about that Mueller investigation? What do you think about the Attorney General's resignation? What do you think about Rod Rosenstein's future? What do you think about Melania's jacket? You will not find those questions on the Consumer Confidence Survey. You will find questions like, do you think the job market is strong? Do you think it'll be better in 6 months? Have your personal finances improved? Will they be better in 6 months? And when people are faced with those kinds of questions, they say, yeah, I'm making it. Now, nation of not quite 330 million people, so there's certainly some bad news stories out there, don't get me wrong. This is on average. But on average, people feel pretty good about this economy. But here's the thing. In this 10th year of economic expansion, rather than narrowing, the economic expansion is actually broadening to encompass more components. And at the heart of that dynamic is a surge in business confidence. The National Federation of Independent Business conducts a survey of small businesses across America. And based on that survey, they craft a small business optimism index. Here I'm graphing for you a subcomponent of that index. Question Small Business America, is it a good time to expand your business? Well, you can see. The answer is absolutely yes. Look how different the responses are relative to 2015, 2016. When very few small businesses were saying, it's a good time to expand my business. For whatever reason, back in 2015, 2016, there was an industrial recession in America. Not an overall recession. Consumer was still spending, global economy was still supportive, but industrial production in this country was falling for much of 2015, 2016. People talk about the 2016 presidential election, and they say, well, that's about James Comey and emails and Benghazi and so on and so forth. It may well have been. But as it turns out, there was a significant weakness in the industrial sector of the economy, manufacturing, distribution, mining. And no surprise, given that, little surprise, that states like West Virginia, Ohio, Michigan, Wisconsin, Pennsylvania, which are industrially oriented, would have gone the way they did back in 2016. One of the untold stories of that election. But industrial production is now surging. And businesses are saying it's a great time to expand. And that takes confidence, because to expand a business means what? Buying equipment now, hiring now, opening up a new office now, and that takes money now, expenditures now, to chase revenues in the future. Well, that takes confidence, because you still got to make payroll every 2 weeks, even if you're spending money now on other things. And by the way, during the most recently enacted tax reform, a lot of attention was given to the headline, which was the reduction in tax rates for C corporations, often large corporations, often publicly traded corporations, not always, from 35% to 21%, and that was a headline that deserves a lot of attention. But small business owners also received a tax cut. owners of subchapter S corporations, LLCs, LLPs. Also changes in the tax code regarding expensing of equipment purchases versus capitalization or depreciating equipment. Also not the elimination of the AMT, the alternative minimum tax, which has bedeviled many small business people in this country. Because the AMT, the alternative minimum tax, really hits doers in our society. People who have taken risks, need to take deductions, but can't do that because of this AMT. And there's still an AMT, an alternative minimum tax, as part of the tax code. But far fewer people will be affected by the AMT going forward, as has been the case in the past. And so, no surprise, businesses are pretty confident. And by the way, it's not as if US corporate profitability was hurting before the tax cuts. If I graphed for you US corporate profits back to 1950 after tax, this is what you would get. One of the frustrations has been that though US corporations have had a fair amount of cash on their balance sheets, they've often been hesitant to aggressively spend that cash in the Main Street US economy. They might have spent that money abroad to expand their capacities elsewhere. They may have issued larger dividend checks to their shareholders, and of course, a CEO favorite, the stock buyback. And I could understand why a CEO would want to repurchase his or her own company's stock, because even absent earnings growth, because shares outstanding declines, you've bought back the shares, earnings per share goes up. When earnings per share goes up, share price tends to rise. When share prices rise, shareholders are happy. When shareholders are happy, the board is happy. When the board is happy, the compensation committee of the board is happy. When the compensation committee of the board is happy, the CEO is happy, the CEO's spouse is happy, and the circle of life begins anew. But, that is not the kind of expenditure that will show up directly in gross domestic product. Building a factory, a warehouse, a hotel, an office building, that will show up in GDP. But what do we now have? We have a combination of capital times confidence. That equals commerce, that equals construction, that equals an economy that's growing quite rapidly. And of course, one of the other aspects of expanding an enterprise is hiring. So it's no surprise, given these dynamics, that America is home to a lot of unfilled job openings, more than 7 million. How many unemployed people do we have in this country? Less than 6.1 million. So how many jobs do we have available for every half dozen unemployed Americans? 7. We have a job for everybody, theoretically. Now, I know what you'll point out to me, which is correct. There's geographic mismatches. So the jobs might be in Hagerstown, the unemployed might be in Cumberland, or in Erie, or in Youngstown. And of course, there's skills mismatches. But there's certainly a lot of job openings, and when we fill a job opening, we create a job. We just got the October jobs report, 250,000 net new jobs added in October. Blew through consensus expectations. Wall Street was expecting 190,000 jobs. The economy delivered 250,000 net new jobs. You see this monthly job creation here? That's 97 consecutive months of job growth in America. So through wildfires, hurricanes, presidential elections, market corrections, each and every month for 97 months, this country has added jobs on net. A lot of people get credit for that, by the way, including people in this room. You stuck with it, you've created a lot of jobs. I salute the members of the Chamber of Commerce. And you've made this community better for your efforts. You create a lot of opportunity, put a lot of bread on a lot of tables. So a lot of people get credit for this. One person takes all the credit. But a lot of people get credit for this. And it must be said that the momentum in terms of job creation has not dissipated over the past year. Over the past 12 months, this nation has added 2.516 million non-farm jobs on net. Non-farm because that's the way the federal government delivers the data. Not because farm employment is not important, of course it is. But that comes from the USDA, the U.S. Department of Agriculture, and those data are not additive to these, which come from the Bureau of Labor Statistics, which is part of the U.S. Department of Labor, for a number of reasons. But if you look at these horizontal bars represent the number of net new jobs created by each of these sectors. So professional business services chipping in more than 500,000 new jobs over the past year, October 2017 to October 2018. Health services, construction, 330,000 net new jobs. I mean, the men are coming back in some sense, because the male unemployment rate during the worst of the recession reached over 11%. That occurred in 2009. Because disproportionate jobs were lost in sectors like construction and manufacturing. It was, after all, a housing downturn. So no surprise, construction took it on the chin. Female unemployment never reached actually 10% during that downturn. The peak occurred in 2010 for female unemployment. So at least male-dominated industries, construction and manufacture, I thought manufacturing was disappearing in this society. I know we've got Volvo in the house, but other manufacturers as well. 296,000 net new manufacturing jobs in this country. Well, of course, because industrial production is surging now in America. They're really very impressive. And yet, I must say, when I point this out to people, how strong this economy is, how terrific this labor market is, more than 7 million available jobs, 3.7% official rate of unemployment, the lowest since December of 1969. People say, you economists, you talk about this strong economy, you talk about this dynamic labor market. If it's so great out there, then why is the US labor force participation rate at 62.9%? Why has idleness been growing in America among American adults? The labor force participation rate, to be part of the labor force, you have to be either working or looking for work. And over the course of this expansion, a growing share of adults can check neither box. We're just a few tenths of a percentage point above a 40-year low in labor force participation. Why? Now, part of that, of course, is demographics, the demographics of the baby boomers. So when baby boomers retire, and why shouldn't they? Dow's at 26,000. 10,000 boomers turn 65 every day. When they retire, that suppresses that labor force participation number. Unfortunately, that's not where the story ends. That we see growing levels of disengagement among many younger Americans as well, including among young American men. This is the labor force participation rate for American men ages 25 to 34. I've graphed it for you back to the year 2000. Now, I can explain, as you can, the decline in labor force engagement among young American men from a 2008-2009 perspective. Back then, there are certain months during which we're losing between 700,000 and 800,000 jobs a month. We lost nearly 9 million jobs over the course of the downturn. Construction and manufacturing jobs were disproportionately impacted. And so a lot of these young men, along with other Americans, were frustrated by their unrequited job searches. But how does one explain this in a 2015, 2016, 2017, 2018 context? Years during which we added or will have added more than 2 million jobs. Well, of course, one explains this by doing the research. And among the leaders in this vein of research are economists from Princeton and the University of Rochester. Their research recently featured in a Wall Street Journal article, but in many other places. And they conclude, based upon their analysis, that there is one factor that explains between 23% and 46% of that. This elevated level of young male disengagement. Not working, not looking for work. In other words, one factor explains between a quarter and a half of this. And what is that one factor? Of course, it is video games. The research indicates that there's an army of young American men who plays video games all day, every day, enough to move the data. So, Anirban, are you saying on this beautiful evening in Hagerstown, Maryland, that there's an army of young American men who plays video games all day, every day? Yes, that's what I just said. I don't know why you're pushing back. But Anirban, I do not see these soldiers. I do not see the men in this army. That's sort of the point. No one ever does. This is called an immersive digital lifestyle. An immersive digital lifestyle. And you might conclude that these young American men who play video games all day, every day, must be very unhappy with their lives. That this is no way to lead an existence. The research further indicates that young American men who play video games all day, every day, are far happier than those who work for a living. These video games are awesome. But Anirban, if they're in their 20s and 30s, from where do they garner their subsistence, the money to support food, clothing, shelter, the economic basics of life? Parents. Parents are easily the leading source of support for that lifestyle. You might ask the question, well, why do parents condone, let alone actively support such a lifestyle? And when those parents are surveyed, the answer is almost invariably, wait up. It's a very dangerous world out there. If our young men are out there, they might do something bad, or even worse, something bad could be done to them. Much better for them to be in the basement. They're so happy, they're always smiling. I'll bring them tea and toast in 15. And so, I'm not saying that all is benign in the US labor market. And again, this is one of the things that raises the specter of immigration policy and how difficult it's become to find workers. But if the question is, can an American looking for work find a job? The answer is, yeah, they've got a good shot. They've got a good shot because there are a lot of job openings. In fact, recently, record numbers of job openings in America. That's true in Hagerstown. You look at the Hagerstown-Martinsburg metropolitan statistical area, almost 2% job growth over the past year. In fact, for much of the past year, job growth in this region has been faster than the national average. No surprise. Because this is an economy that is impacted by the presence of I-70, I-81. There's more manufacturing here. There's more distribution here. And so when industrial production is rising nationally, that has a disproportionate impact on the Washington County economy. When industrial production was struggling in 2015, 2016, this economy was not performing that well. You'll remember enormous frustration because, of course, the housing market really took a tumble here. So that affected years like 08, 09, 10, so on and so forth. And then the recovery was snuffed out in 15, 16 because of the decline in industrial production. But it's a very different story in 2018. 2018, a much stronger economy. And by the way, the leading sector in terms of adding jobs is the supply chain. Retail trade, wholesale trade, transportation, utilities. That's the supply chain of the U.S. economy. And so when you've got a Hagerstown metropolitan area economy that's adding jobs in both distribution and manufacturing, that's pretty good. And overall job growth has been pretty strong in this region. This is Hagerstown-Martinsburg employment growth over time, just to give you some sense. That it really, look at 2015, 2016. You see how weak it was at that point? The recovery sort of started and then ended. Not now. You can see the amount of jobs being created on a year-over-year basis has surged higher. This is employment growth for the 25 largest metropolitan areas in the country. Washington Metro at number 13, Baltimore Metro at number 18. Not awful, but note the dominance of the American South and West in terms of generating the highest rates of job growth. So at the very top, Orlando, Southern Market, Houston, Southern Market, Miami, Southern Market, Phoenix, Southwest, Tampa, South, Seattle, West, Dallas, South, Riverside, Southwest, Denver, West, Charlotte, South, Portland, West, Atlanta, South. See the pattern? Because that's where the population is growing. And that's, I gotta say, that's a challenge for us here in Maryland. And a lot of folks in our state do not understand how devastating it is when a community loses population. I mean, you can see it in Allegheny County next door. But we've got to hold on to our citizenry. We've got to hold on to our taxpayers the best we can. But we have a tendency to drive out our taxpayers. We suffer significantly from negative net domestic outmigration. We lose taxpayers. And I got to tell you, after yesterday's elections, I think economic development in our state becomes more challenging. Not to be too partisan about this. I don't care if someone's a Democrat or a Republican. I really don't. I want them to be pro-business, pro-commerce, pro-investor, pro-doer. Democrat, Republican, Independent, I don't care. But people say, oh, Governor Hogan won the election. Well, I'm pretty happy about that, I got to tell you. Good for business, open for business, all that. But it was a change election. So in Howard County, Maryland, County Executive Kittleman lost that race. Happened to be a Republican, very pro-business. In Anne Arundel County, Republican Steve Shue lost that race in an upset to a guy named Stuart Pittman. Stuart Pittman, who, during his victory speech, thanked the unions for their support. In Montgomery County, Mark Elrich, who has called himself in the past a socialist, won that race over independent Nancy Florine. And so, in Baltimore County, my county where I live, Johnny Oshefsky won that race against a Republican, who happens to be the Maryland Insurance Commissioner, Al Redmer. And again, I don't care if it's Republican versus Democrat, but a lot of these people were not elected on pro-business platforms. And so, it makes Washington County that much more important. Because I really believe this is a very pro-business community. And by the way, one of the things that I think really improves the outlook for this community is what's going on with the EDC. You've probably heard this. You've probably heard about the reforms, moving this out of government, making this more of a public-private partnership, the Economic Development Commission, giving it more autonomy, trying to make more deals. Because one of the issues here is that in certain parts of the state, they don't really view themselves as having to compete for anything because they're right next to the federal government. But you have to compete with the Pennsylvanians and the West Virginians and the Virginians, and that's not easy. And Annapolis, the policymakers in Annapolis, and we have some here, great senator here, obviously, he'll tell you that, He campaigns on that. I'm awesome. And he is. They don't create a business climate that makes it easy for the Washington counties and Allegheny counties to compete, or the Kent counties, or the Talbot counties, the folks on the Eastern Shore to compete with the Delawareans, for instance. And so I'm so glad the EDC is doing what it's doing. I'm so glad the Washington County economy is performing better than it has in more than a decade. Now, one of the other aspects of economic life, and this is, again, employment growth for the 25 largest metropolitan areas, is unemployment is low everywhere. That's your challenge, isn't it, as business people, finding talent? I mean, business volume is pretty good. When I talk to construction firms, many of them tell me, we have more work than we know what to do with, but we can't find electricians. We can't find welders. We can't find carpenters. We can't find roofers. We can't find superintendents. We can't find estimators. That's the challenge. Unemployment is low everywhere. And this is unemployment rates for the 25 largest metropolitan areas. We just got the update on these data yesterday. Baltimore Metro down to 4%. Washington Metro down to 3.3%. Minneapolis down to 2.2%. And so one of the things that implicates is that wage pressures will continue to build in 2019. Workers are going to get more expensive faster. Amazon is not a 501c3. They're not. They're a for-profit. They're very much for-profit. But they raised their minimum wage to $15 an hour, not for charitable purposes. Why do they do something like that? They do it because they know that's what it takes to hold on to people right now. Because if you don't do something like that and you're Amazon, who's the most likely worker to leave? Your better worker, the ones who can interview, the ones who have marketable skills, the ones who can put together a resume. So the average quality of the workforce, therefore, deteriorates as those better workers leave. They want to prevent that, $15 an hour, which in many workers' minds now is the new minimum wage. It's not Maryland's $10 an hour. It's not the federal government's $7.25 an hour. It's $15. And many workers will say, I don't want to make the minimum wage. 15 is not good enough for me. I'm not a minimum wage worker. I need 18, 19, 20, 21. Pay up. And this is a dynamic you will see at work next year, and in Washington County as well, because you look at Washington County's unemployment rate down to 4.2%. Multi-year lows in unemployment in this region. You look at unemployment rate over time, you can see how sharp the decline has been over the course of time. This is also a community that is finding it increasingly difficult to find available workers. And shifting immigration policy will not make it any easier. And so this has many implications. And it's not just wages that are rising faster. It's, healthcare costs have been on the rise, tuitions have been on the rise, apartment rents have been on the rise, borrowing costs on the rise. So when inflationary pressures build, interest rates tend to rise, borrowing costs tend to rise. And that has many implications for many things, including, of course, for the housing market. Let's talk about that now. So here is the most distinctive characteristic of the current economic expansion cycle, the fact that interest rates have been so low for so long. Here I'm showing you a couple of interest rates of interest, the 30-year fixed mortgage rate in blue, the 15-year fixed mortgage rate in red. Now, if somebody had come up to us in June of 2009 and said, look, here's what's going to happen. Recession ends this month, and then we're going to recover for 9+ years without interruption, and mortgage rates will be no higher after those 9+ years, than they are now during this recession. I can't speak for you, but I know what I would have said. I would have said, I don't think that's right. Undoubtedly, after 9 years of economic expansion, interest rates will be far higher than they are now during this recession. But if you look at the data carefully, you'll see that the 30-year fixed mortgage rate in blue, the 15-year fixed mortgage rate in red, are almost exactly where they were in mid-2009. And you might have thought that in a nation that's added about 20 million jobs since the end of the downturn, with consumer confidence racing higher, with unemployment at 3.7%, with money being so cheap for so long, more Americans would have jumped into the ranks of home ownership. That's precisely what did not occur. Sorry, this is homeowners in millions, the blue line. That's homeowning households in millions. Between 2006 and 2017, the population of homeowning households in this country basically did not budge. But the population of renter households went up 26%. Now, the housing stock in Washington County is very much tilted towards home ownership. So that matters. Where were the renters for the most part? Well, the renters are in Washington, D.C., in downtown Baltimore, and in Towson, and Owings Mills, and so on and so forth, more metropolitan area markets, inner suburbs and inner city. The only thing I want to point out to this audience, and I think it's another thing that will be spectacularly good for Washington County, is that home ownership in this country is about to come back with a vengeance. Not immediately, because interest rates have risen and so on and so on. But over the next 5 to 10 years, you will see tremendous performance in Washington County's housing market. Why would I say such a thing? To ingratiate myself to the audience? Yeah, partly. But mostly because of demographics and the notion of demographics as destiny. Ask yourselves, what is the most common age in America this year? 26. So somebody played a strange game with you, said, okay, close your eyes, I'll put an American in front of you, guess their age. You would guess 26 to maximize your chance of being correct. What is the second most common age in America this year? 27. What is the third most common age in America this year? 25. We have a lot of 20-somethings in our society. It makes life difficult as they are obnoxious. They must know that we can hear their music through their headphones. They do not care. And by the way, they are not streaming the Rolling Stones or Queen or the Beatles or the Who or Jethro Tull or David Bowie or Talking Heads or Michael Jackson. They are streaming pure crap. And they're doing it at volume. And I also know, parenthetically, that there's a lot of skepticism regarding economic forecasting and economic forecasters. That when we forecast, you have a tendency to be quite skeptical about what we're suggesting will happen. It doesn't stop me from forecasting, but I know that we're often greeted with skepticism and sometimes hostility. You watch. I mean, a lot of these 26-year-olds, as I point out, play video games all day. But they're also members of the most educated generation in American history. And many of these 20-somethings are really go-getters. They're very ambitious. And they end up living in some really pricey apartments in their respective downtowns, whether in downtown Washington, downtown Philadelphia, downtown Baltimore, downtown wherever. Hagerstown. Downtown Hagerstown. It's been known to happen. And in fact, they pay more in rent on a monthly basis than they would for a monthly mortgage. I mean, they pay more to rent in many instances in these cities. And I understand part of why they do that. They want to stay geographically flexible. So today it's Washington, D.C., tomorrow it's Austin, then Silicon Valley, then Boston, Philadelphia, then so on and so forth. But you watch. Again, my first forecast of the evening. These 26-year-olds living in these fancy downtown apartments, expensive apartments, you watch. In 10 years, they will be 36. It's a forecast. And a lot happens during those 10 magical years, right? You know, people have children, they get married, often in that order. And all of a sudden, renting is not their best option. And by the way, I don't have to speculate on this. I can see it in the lines. What do you see flattening out over here? It's the renter population that's flattening out. What do you see taking off now? It's the homeowner population. The home ownership rate in this country is back up to 64.4%. It's not falling anymore, it's rising. We're already seeing this dynamic, even though the most common age in this country is 26, but in 10 years, it'll be 36. So you can imagine. You know, one of the inducements to buying a home, of course, is rising home prices. As I point out to folks, young and not so young, you will never get rich renting. You will never get rich renting. I'm not saying renting is bad. I was a renter once. But I didn't think it was going to make me rich. I could pay my rent each and every month religiously, first of the month, right on time. I had nothing to show for it at the end of the day. I wasn't homeless, I was good, but I had no wealth to show for it. But you buy a home, one buys a home, there is an opportunity for them to build wealth. And one of the things that we know when you look at Case-Shiller and other data is that some of the largest home price increases have been in the millennial-centric markets like San Francisco and Denver, Los Angeles, Atlanta, Boston, Miami. And one of the other things is that though everyone knows this demographic push is coming, the 20-somethings turn into 30-somethings, as a country we've built very few single-family homes. There's scarcity out there. There's a housing shortage out there. This is U.S. single-family housing starts, graphed back to 1999. We build very few houses today versus 1999, when the population was much smaller. So that's an opportunity, as it turns out, for Washington County. And because Frederick County has become so much more expensive, and Montgomery County has been expensive, and Howard County just changed its adequate public facilities ordinance such that it's very difficult to build a home now in Howard County, because you fail the adequate public facilities test, mostly because schools are defined as being overcrowded. In my mind, it means that there is going to be a significant population looking to live in Washington County. You can call it a caravan, I wouldn't. But there's going to be an opportunity here to build tax base and to add to labor force. Okay, all right, fine. Enough of that. That's the macroeconomic backdrop. I do want to get to Q&A, and thank you for your indulgence. But before I get to the forecast, the final part of this presentation, I want to take a step back and do some review, where we have been together thus far this evening. So we've talked about the global economy, we've talked about the national economy, we've talked about Washington County dynamics and Maryland dynamics. We've talked about the labor market and financial markets. We've done that, some policy issues. And I understand that our perspectives on these things differ. I get that too. You're sitting down looking this way, I'm standing up looking that way. From my perspective, this presentation has been spectacular. In terms of delivering upbeat information to you. It's been really positive. We've talked about a terrific job market, surging stock market. I mean, I could show you a list or a litany of leading indicators that all be positive. I'll show you some more in a moment. So if things are so good, and industrial production is surging, and economic growth is now 3% or a bit better than that, and there's momentum, then why, I ask, am I having my 19th nervous breakdown? Why am I so nervous about this economy when I think about it? Especially, again, when the headline numbers are so good. So often I've begun presentations in Washington County with this slide, gross domestic product. It's a natural place to start. It's the broadest measure of economic performance. We just got the third quarter data, 3.5% growth on an annualized basis after the better than 4% performance for the second quarter. This is really quite impressive. And leading indicators suggest that this momentum is set to continue as we go into 2019. So this is the Conference Board's Index of Leading Economic Indicators. These vertical bars represent the percentage change in the value of the leading index from month to month to month. So what this says basically, because the 0% line runs east and west through the slide, is that each and every month recently, the value of the leading index has gone up and up and up every month without fail, telling us that, hey, we've had a lot of momentum in this economy. We will have plentiful momentum going forward in 2019, so why would anyone be nervous? I am nervous because others are so confident. And people have a tendency to do foolish things or to overdo things when they're confident. Like, for instance, take on too much debt. Here I'm showing you three forms of consumer debt: mortgage, auto, credit card. I've indexed the data to 100 back to 1999 and then grown the respective series forward. That period of household deleveraging, paying down debt, that ended many years ago. People are now ramping up their household debt. I left student debt off this chart because student debt is growing so rapidly that if I put it on this chart, all the other lines flatten out because the y-axis goes like that. So, the last financial crisis, of course, was a global financial crisis. We all participated in that, whole world. And so, one of the other aspects of economic life, and I point out that it's not just the U.S. consumer who's taking on more debt. The entire world has been taking on more debt, gobbling up debt. The International Institute of Finance conducted a study based on 2016 data and concluded that as of that year, total global indebtedness had reached an all-time high. We just received the Q1 2018 update on that analysis. As of the first quarter of the current year, total global indebtedness, $247 trillion. That's equivalent to 318% of annual global output. We have never seen numbers like this. We've never seen a world so indebted. As the International Monetary Fund and others have warned, the sheer size of this debt could set the stage for an unprecedented private deleveraging process that could thwart the fragile economic recovery. My goodness. So much mumbo-jumbo at 8 p.m. after dinner. My goodness. Let's break that down, shall we? Two key words there. Number one, private. Because I'm aware, as are you, that America's national debt is $21 trillion. There's intense indebtedness among governments in Japan, Italy, China, elsewhere. But 2/3 of all global debt is owed by the global private sector, including a surprisingly leveraged U.S. corporate sector. You say, how could that be, Anirban? How could the U.S. corporate sector be so leveraged Companies have been generating profits hand over fist for years. That's what happens when you buy back your shares every year. You issue debt to buy back your stock, debt goes up, equity goes down. My younger daughter is 12 years old, and accordingly, her favorite store at the mall is Claire's. Claire's sells almost everything fabulous. Hair clips, squishies, phone cases, glitter, My Little Pony. I shop there. And you say, well, Claire's is at every major mall in the country. It's always busy, that store. But they're in some deep financial difficulty. Why? Because several years ago, a private equity firm, Apollo, leveraged up their balance sheet to maximize return on equity. And so they have very little free cash flow at this time. People say, Toys R Us, they went bankrupt because of Amazon. That's why. And don't get me wrong, Amazon had an effect on Toys R Us. But many years before the Amazon effect was truly felt at Toys R Us, a group of private equity firms, 2005, leveraged up their balance sheet. So when the Amazon effect really began to wreak havoc on their business model, they did not have enough free cash flow with which to reorient their business. You buy a child a toy on Amazon, when will they get that toy? Maybe tomorrow. When do they want that toy? They've been crying for 4 hours. Many of us drove to Toys R Us like we were driving an ambulance. It's just an emergency. Just get there, honey, get there. This kid's going berserk. And this is the time of the year to go to Toys R Us, isn't it? Holiday shopping, Christmas shopping season. But you will not go, and I will not go to Toys R Us this year, because they're not just bankrupt, they're liquidated. And so what I'm suggesting to you is this, that there's a fragility out there, that there's quite a bit of corporate indebtedness out there, and so it would not take much economic deterioration to find ourselves in a situation in which all of a sudden companies that have been hiring aggressively are all of a sudden not. And this is not just an American issue, this is a global issue, because the globe is so indebted. Now, the other key word here is unprecedented. Because unprecedented means worse than the most recent financial crisis, which I don't think is going to happen, by the way, because the US banking system is in such good shape. But one could understand from a global perspective why people would be so concerned. Because the world is home to far more debt now than we had in 03, 04, and 05, when the seeds of that global downturn were being sown. Now, it's okay to have debt on the balance sheet as long as the assets are valuable. And asset prices are high right now. Stock prices, of course, are a good example of this. This is my favorite measure of the price-earnings ratio on the S&P 500. It's the Shiller price-earnings ratio. You will not hear this spoken much about on CNBC or Bloomberg. But it's my favorite measure. Now, the denominator is earnings. Don't get me wrong. Earnings growth has been phenomenal. For instance, you saw last week earnings announced by General Motors and many other companies. Off the charts, terrific. Amazon not quite as good, but generally speaking, earnings growth has been terrific. But the numerator is price. And even if the denominator is growing nicely, it's possible for price, the numerator, to grow too far too fast based on economic fundamentals. I like this measure because it's so predictive. When have price earnings been elevated? 2000, before the dot-com bust. 2008, before the failure of Lehman Brothers ushered us into that financial crisis. And now. And of course, after today, price earnings went up even further. And I defy anyone in this room, and I know that I'm amongst the cognoscenti, I defy anyone in this room to explain this to me. Please do. It's the price of Bitcoin. So tell me about blockchain technologies, please. Tell me about Litecoin and Ripple and Ethereum or Bitcoin, whatever you want to do. I still will not understand it. I entitled this slide, by the way, Shattered, because Shattered is another Rolling Stones song, an uncommonly good one. But also, I dedicate this slide to someone who played a role in my life. I've never talked about my life for 16 years here. For 16 years, one of the things I've worked to do here in Hagerstown is to build credibility with this audience. I've really worked hard to do that. I'm about to do something that will assure that I will lose whatever credibility I've built up with you, because I'm about to say something that you will deem to be untrue. I had a girlfriend in high school. I did. Let's call her Elaine, because that was her name. And Elaine loved the Rolling Stones. It's one of the reasons I picked the theme this year, for her. But it wasn't so much that she loved the Rolling Stones, it was who she loved. She loved Mick Jagger. Worshipped would be a better word. So much so that I spent my junior and senior years of high school jealous of Mick Jagger. She broke up with me on February 6th of 1987. And I'm over it. I don't even think about it anymore, really. Anyway, this slide is for her, shattered. But I'm not the only one that's been shattered. People who bought Bitcoin at 19,000, 18,000, 17,000 also shattered because lately it's been below 7,000. Why are people doing this? Why are people investing so much in things like cryptocurrencies? Things they cannot possibly understand. Things like marijuana. Things that are still pretty risky given that the federal government still deems it as legal activity. Why are they doing that? A, they've got a lot of money to invest. B, they don't have a lot of great options. Everything looks pricey or generates very little income. And C, they're confident. And confidence sometimes translates into recklessness. And so my final slide. Look, the economy is good right now and will be well into 2019. This year, America set up for its best year since 2005. That was the last time the US economy grew 3% or better. That year we grew around 3.5%. Many support mechanisms. Global economy is better than it was still. Job opportunities have been abundant. Companies have been looking to expand their enterprises. Corporate profitability elevated, consumer business confidence surging, and now tax cuts, including major reductions in corporate taxes. And by the way, these tax cuts have been in operation for less than a year. So the effect is still, much of it is still in front of us, not behind us. So why am I so nervous? Well, that's the second column. Because things can go wrong. Now, on the one hand, there's the so-called outside events, the so-called black swan threats. So again, if somebody played that very strange game with you, close your eyes, I'll put a swan in front of you, guess the color, you guess white to maximize your chance of being correct. But there are black swans in nature, quite striking creatures. So your probability of being incorrect is non-zero. There's some low probability that you would have been incorrect. And accordingly, a black swan threat or event is defined as a low probability event that if it were to occur is of a magnitude that can alter the trajectory of financial markets, even broader economies. 9/11, of course, a classic black swan. Because if somebody had laid out that scenario for us the Monday before that Tuesday, I can't speak for you again, but I would have said, impossible. It cannot happen, certainly not in the United States of America. I will assign 0% probability to that outcome. But it did happen, which means the probability was non-zero. And financial markets have a very difficult time pricing in those low probability risks, like cybersecurity attacks on a major financial institution, electromagnetic pulse, Korean Peninsula, Iran, whatever it happens to be, biological contagion. We call them low probability for a reason. We don't think they're going to happen. But every once in a while, a black swan does occur. But set that aside, those outside events. Let's talk about the current workings of the economy and what could trigger the next downturn. I'm forever blowing bubbles. Pretty bubbles in the air, they fly so high and they reach the sky like my dreams, they fade and die. That is a theme song or chant for the English Premier League football or soccer team, West Ham United, the Hammers of East London. And if you were to go to London Stadium and watch the Hammers play, you'd see a bunch of burly blue-collar blokes blowing bubbles and belting on this tune with particular ferocity during the onset of the first and second halves. It's quite a scene. By the way, Liverpool gave us the Beatles. London gave us the Rolling Stones. You see how beautifully this presentation holds together? And a West Ham United fan, as a West Ham United fan, it does raise the question, where are all the pretty bubbles? Equity markets, being stock markets, US bond market, commercial real estate, Bitcoin, could be all of the above. One does not know, I do not know, if there's a bubble until after its burst. I can suspect, as we economists did back in 98, 99 about the dot-coms. We looked pretty stupid at the time, by the way, when we suggested it. Did not understand why these companies had so much value when they had no revenues. That bubble burst in March of 2000. By 2001, we're in recession. Did not take long to go from the boom of 1999 to the recession of 2001. Remember 2005? How great it was around here? Home prices were rising. People were taking hour-and-a-half commutes to Washington, D.C., whatever. I want to live in Washington County. I want a big house in Washington County. Until the second quarter of 2006, that bubble bursts. By 2007, we're in recession. It does not take long. That's the message. And so 2018 has been better than fine. It's been a terrific year for the economy. Hopefully, I was sufficiently upbeat in my forecast last year, because it really has been a good year. I think 2019 is shaping up to be a decent year, too, from the perspective of job creation and business investment. But subsequent to that, I expect a potential deleveraging cycle prompted by a downward repricing of assets. These high asset prices come back to earth. And what's going to cause that? More inflationary pressure, higher interest rates. Higher interest rates are not good for asset prices. That was the October story. And of course, when that occurs, when that dynamic plays out, it'll be bad. Exclamation point, exclamation point, exclamation point, exclamation point. That looks like a tweet. So please do follow me on Twitter at Say Anirban, because I'll be talking about these issues all year round. And as a final point, the final point, the next downturn, and it will occur because every recovery in American history has come to an end. This one will too, presumably. But the next downturn will not be nearly as bad as 07, 08, 09. I'm thinking of something akin to the 2001 recession, which lasted less than a year, March of that year to November, but took a lot of wind out of the sails of the financial markets. Investors, NASDAQ and so on and so forth, took a big hit. But the broader economy came back pretty quickly, and I think that's the story for the next downturn, whether that begins in 2020 or 2021. I'm speculating, but that's how I think things are going to play out. Washington County, Hagerstown, thank you so much for inviting me. It's been a privilege as always. I'll take your questions now. Thank you.